Hello, everyone. Chris Martinson here of Peak Prosperity with Paul Kiker of Kiker Wealth Management. Hey, Paul. Good to
Good
see you
morning,
again.
Chris. Good to see you
Wow.
again.
I'm looking at my screen. We got all kinds of stuff happening this week. I really want to go into a lot of it. But the two big things that I really want to cover with you so that people can understand here, this is Finance University. So let's break some stuff down. GDP came in nice and hot. Ooh, smoking 4 point whatever, 6% or 9. I forget what it was, something high. Right. And then what's going on with the Japanese yen? We've talked about it before. I think
Mhm.
Japan's in a real world of hurt here because they're trying to do two things at once and you can only do one of them. They want to control the price and the quantity of money. I think they're losing control actually of both.
Agree.
So we'll see what happens here. So that's what's on my plate. What's on your plate?
Markets are delivering a lot of information over the past couple of weeks. We had mentioned over the past couple of months this being the danger zone,
Yeah.
and it's highly possible that we're entering the super bubble's final act, and the market's given us a good indication of that. Jeremy Grantham wrote a good article back in September the 1st of 2022 where he very eloquently describes how these super bubbles come apart. First the bubble forms. We've seen that through unbelievable central bank intervention over the past since 2008. I mean, just crossing every absolute boundary that was drawn in the sand before. Then we finally get this setback, in first part of 2022, and then we get this rally. So I think we're in the final stages of that super bubble because what we're seeing is the market pulls back. Investors get a chance to buy Google after it drops 50%, Nvidia after it drops 50%. And now all they can imagine is the central bank intervening and us getting back to those all-time highs. And then the market starts to roll over as the fundamentals deteriorate. So it's possible we're in the final stages, of this super bubble starting to come apart. So it's quite interesting, watching. We're seeing certain areas of the market. You've been talking about the popping and creaking that's taking place around the edges. Japanese yen is still having issues, the Mexican peso. You've got major defaulting according to Unusual Wells on Chinese property dollar bonds. Their statements like 70% of those are in default right now. So this is a time where those who are prepared and those who are adaptable, can put themselves in a position to protect themselves through what's coming in the months and years and days ahead. So interesting times, great times, fun times. This is what we're here for. This is what we're here to do and to navigate.
Well, I'll tell you, I like interesting markets. I would prefer an interesting market than a boring market. A boring market doesn't make a lot of sense to me because it just sort of floats higher up and to the right, and all that stuff. And then you have to sift through these really annoying, probably just written by AI articles that try and explain to you why NVIDIA in the upper outer stratosphere can only go higher, right? And I'm just like, yeah, as long as they can grow their profits by 50% per quarter forever, you're right. It makes sense. It's just like these really dumb rationalizations that I find insulting from time to time. But can we turn now? I want to just very quickly turn to this, which is we'll call this GDP fictions and realities. Can you see that?
Yes, I can.
All right. Well, this was the news. Jesse Cohen on Twitter writing, hey, U.S. economy great at an annual rate of 4.9% during the third quarter, blowing past expectations for an increase of 4.3, accelerating from growth of 2.1 in Q2. So this sounds great. I want to tear this apart a little bit because unfortunately, Paul, every single time I look into a government report, I don't care if it's a durables, retail sales, a CDC report on cases of COVID, every single time I peel back that cover one tiny layer and I go, oh, what a junk. It's, I wish we had, see, here's what I want. I want us to have statistics we can believe in. I believe that this is the equivalent, as we'll see, of flying an airplane where your altimeter's off by a few thousand feet.
Yes,
Not a
it is.
not a good idea, right? So they say here, number three, real consumer spending jumped at 4% year over year after increasing just 0.8% in Q2. So real consumer spending, of course, meaning it's been inflation adjusted, And it says, despite fears of a looming downturn, U.S. economy continues to grow at above average pace as consumer spending remains resilient. And their takeaway was, well, actually bad news for Federal Reserve. Fed might have to raise rates one more time, maybe, because things are just so hot, so good. And it was a Goldilocks number that we had, Paul, because why I looked like, oh, stock futures vaulted higher and gold and oil went down for some mysterious reason. Like, why would oil go down? Because the economy is getting stronger. That's bizarre. Anyway, blah, blah, blah. So this was the news here. I'm going to show you. This is where I get all my stuff from. This comes from bea.gov, right? That's the basic news. This is what it did. And again, mysteriously, not just US stocks, which would be the Dow Jones Industrial Average, the DJIA, the S&P 500 up there, and the NASDAQ 100 in the lower right, but also the Nikkei, the Euro Stocks 50, the DAX, all of them super cheered.
Everybody's
excited.
Happy.
Everybody's happy at the exact same moment because the US economy expanded faster than expected. Anyway, I just put this up there because let me talk about this real quick. That chart I just showed you there, Paul, that's what concern I have. And I talk with a lot of people about it. And the reason I have a concern is because it says there's no diversification. This is one big market now. It's all the same market. It's a blob. And the reason that bothers me, Paul, is it means there's no diversification. This is like we just, our central bankers in the financial system in their infinite wisdom said, I know, let's build a big ship without any bulkheads.
Right.
You puncture the hull in one spot and the whole thing sinks, right? That's my concern about it.
Well, that's a legitimate concern. I mean, what's an investor to do? And it drives behavior is what it does. And it, to an extent, punishes you for putting the research in and spending time to diversify your portfolio. So really they're driving all your behavior to the big corporates. Hey, buy an index, buy an index. Don't spend any time on your own doing the research, and the index are able to control the large money flows that come into the market, and they're absolutely price insensitive buyers. So, to me as well, I sit back and laugh. The question that I'll ask now when you see the market jump that much is how long does it last? Right? How long does this last?
Well, and if that jump lasts for a long time, well, to me that means there's plenty of liquidity in the system, and the computers are happy, playing pickleball with each other as they sort of like work their way through all that money. But when you see the pops last for just a little bit of time, like a week, a day, or even just hours, to me that tells me where we are in the story. And when you see them starting to last less than a day, these pops, it means that the computers are no longer content to play pickleball. They are busy taking money off the table, and they're happy for the pop because they can get stuff out the door at a better price, right?
That's right.
That's what I'm seeing. That pop I just showed everybody here, Paul, that got burned up in about an hour this morning. It was gone, went away
in a hurry. It was gone in a hurry. And it's interesting to watch the futures up every morning and then they turn around and decline the other way. And really it's the psychology behind the most dangerous thing for the individual investor that doesn't have a plan, who doesn't really understand what's taking place and doesn't stay patient. It sucks them into this market, right? Oh my gosh, I'm going to miss this opportunity. And it pulls people in while the big institutions are able to dump money out on the individual investor, and they're not the one holding the bag. It's the average investor who doesn't really understand what's taking place in these markets.
Yeah, I agree. And there's a degree of risk here that's also hidden. So let's just compare, say, the Dow Jones Industrial Average, 30 large cap companies, nominally supposed to be industrials, but the composition's a little weird for that. Anyway, 30 biggest companies in the US, and the Nikkei 225, the largest 225 companies in Japan. And look at this behavior as we're coming down. This market's closed, by the way, at this point. So this is just futures trading while everybody's asleep. Nobody's buying or selling a single share in Japan, but the futures are still open. And so we see, everything's sort of wobbling down, and we're coming into the 8 o'clock, 8:30, this announcement comes out, and you see there was this initial pop down with this big volume spike, and then it goes up and wobbles off. In Japan, 12 time zones away.
Right.
Quick little pop, exact same volume pop, exact same volume signature all the way across the bottom, exact same behavior. Everything's identical. So the concern there is, well, does this work both ways? What if Japan's market suddenly gets in a huge amount of trouble for some reason? Does the lack of a bulkhead between these two markets mean that the Dow gets in trouble? Or is this just a one-way thing? Don't know, but I'm concerned because this behavior, Paul, this didn't used to do this when I first started learning about markets and trading, back in the early 2000s, which is when I really started paying attention, and futures really took off in my awareness around 2005. I traded futures intensively 2005, 6, 7. It became full contact sport. I was not enjoying my life, so I stopped, but I did it actively. So I know what I'm talking about here.
Yes.
This didn't happen. I had hedging strategies, right? Where I might, be short a simple hedging strategy might be short the dollar, long gold, or vice versa. Because if one moves one way, one tends to move the other way, right?
Correct.
There's no way to hedge across these markets now.
No,
There's
there's no
thing.
way. There's no pair trade when they're all moving in the same manner. The question that I always ask myself is, have the central banks, we've seen massive combined intervention around the globe. It's like they call each other up. We're going to make a move. Let's all do this together. So now are we seeing, which it appears that we are. I don't know how I can't understand why this phenomenon would occur so consistently unless you have mass global intervention, because this super bubble has reached the point that they all understand if one goes down, everybody else gets pulled down with them.
Exactly. Right. That is the concern. And of course, Timothy Geithner, enshrined that in the systemically important banks, the SIBs, too big to fail. Right. And here we are. And so now I think it's a lot of BS and narrative control because they're afraid, when I was, if you looked into like, say, the Lahaina fires, right? They said flat out, straight up, the governor at one point said, we don't want to release the number of deaths because we think that will demoralize people, really make people upset, right? It's this whole idea that if you're in an official position, even as lowly as a governor dealing with a tragedy that calls for transparency, your first instinct, in the way that we run our governance, is to say, well, we couldn't think what would happen if people got access to the real truth.
Right.
We have to protect them, their pretty little heads, from knowing what's really going on. And it just, I think lying is now so ingrained that it's reflexive, Paul, and that the only way to fix it would be to fire everybody at the BLS or the BEA and start over with a whole new set of people.
I agree, because with the amount of lying that's taking place and the fact that they're not even ashamed of it, right? Like they're doing it for the headline numbers, realizing they're going to revise the data down, 60 days? They don't even try to hide it. There's nobody there standing up for the truth. And the only way to replace that is to clean house.
I totally agree.
And then there's others in there. I'm sure there are people in there that may not agree with it, but they need their jobs. And quite frankly, patriots are going to have to stand up for the truth and trust that wherever that takes them is the path that is the most appropriate for our people, our country, and their own lives. So we've got a courage problem in a lot of those institutions now. Either that or they're just all corrupt. I mean, all that corrupt, or a combination of both.
Yeah, I agree. So let's look at I just want people to understand that there's you have, on my view, you have to understand the ways in which they're running these deceptions so that you can develop a strategy and figure out what you want to do about it, right? And so what if they're wrong about how much GDP is out there? What if that's true? So is this showing up? Did I get that right again?
It is.
Yeah, so they say here the increase in real GDP compared to nominal, real, of course, again, inflation adjusted. They say it reflected increases in consumer spending, private inventory investment, exports, state and local government spending, federal government spending, and residential fixed investment. So that's what drove it. A little offset by a decrease in non-residential fixed investment. Those are, of course, commercial buildings. They had to actually admit, well, maybe they're not putting up quite as many office towers right now. Okay. But other than that, everything else was on fire, buddy.
Yeah, the
right?
key there is state, local, and government and federal spending.
I agree. Oh, exactly right. So look at this. They said current dollar GDP increased 8.5% annual rate, or $560 billion in the third quarter. So this is the third quarter calendar year is how they do this, because the government's fiscal year is on a different quarter system. So this is July, August, September, right? It's $560 billion. Okay. Well, to your point, let's go to the fiscal data from the Treasury Department and find out that that's July down there in 7.3, right? So this is from July, August, and September. We see here that $846 billion in additional deficit spending happened in, in that quarter.
There you go.
Woo! We're number one. Get the foam finger out. We're number one, right? Look how strong our.
And then they brag about how great things are. We're doing this fantastic job in the short run, and all I can think is, yes, you're destroying future generations for your own ability to brag here in the short run.
I know, it's such short-termism. Let's see. So let me see if did I put. Oh, wait a minute. I might have to skip forward a couple. Yeah. So no, not this one. Yeah. So look at this. They said teasing apart all this growth. So government consumption expenditures increased 4.6% year over year. Federal 6.2%. That's how much it added. Wait, it was a 6.2% growth, they said, which included defense at 8%. Oh my gosh, I guess fighting wars is expensive. Who knew? Non-defense at 3.9, state and local at 3.7. Now this is real. So the problem with this, Paul, is that you then have to subtract out the price increases. So let's say the federal government spent 10% more, but they said, oh, but inflation was 10%. They would still log that as a 0% real contribution, right? Mm-hmm. So they spent a lot more, but what did they? Let's look. So this part drove me nuts. Price indexes for this whole thing for 2023 is the yellow over here on this far side over here. Let me get my laser pointer out. This drives me nuts. Personal consumption expenditures, they said, had a 2.9% year over year increase. Now, if those had a 3.9%, we would have seen a whole point shaved off of GDP. And if it had been 4.9, we'd have seen 2 whole points shaved off. So do you think, in your experience, that you experienced a 2.9% year over year increase in goods and services?
Absolutely not. It's closer to 6 or 7%.
I would say so, yeah.
Yep. Far higher than that.
Yep. That's what I think as well. But isn't this fun? So the government adds it up and says, well, you as a private citizen, you experienced only 2.9 in average. And it's a sum of all these numbers down here, right? And interestingly, they say durable goods, you actually got a 4.4% deflation in the cost of durable goods. I'm like, you guys need to go car shopping, and you should have seen what my last washer and dryer cost.
That's what I was going to point out. How much more did you pay for the last water heater that you added, Chris?
My gosh. Lots more.
Yes.
Lots more.
Oy. That's so disappointing. I mean, it's not surprising at this point, but it's just ridiculously disappointing. And the concern that I have from a money management standpoint is, how many of the institutions out there are just blindly trusting that the data that's coming out of the government is correct, and what investment decisions are they making based upon that? So, 4.4% loss. We've actually been car shopping for my wife for about 12 months. We've not seen, until the past week or two, we've seen a slight softening in prices just because inventories are starting to pile up again. And they're not moving inventory, but prices have not declined dramatically enough to reflect a 4.4% reduction in durable goods.
No, but here's the fun part. So while the government says, well, you private little citizen, you experienced 2.9% inflation. So we're not going to subtract that much from your expenditures because that's awesome. But we want to make the government look better. So what if the government experienced, oh, look at down here. The government experienced 4.5% inflation. Hey, we're the government. our stuff cost more. So it looks like the government spent less than it did because they had to subtract that. So somehow the government is trying to claim that they experience at the federal and state levels of about 4.5% total inflation, but you experience something far less than that. This is okay. This is statistical vandalism right here.
Absolutely. Absolutely. And I would say the government's choosing to pay a whole lot more just to try to do anything that they can do to push money into the economy from a fiscal stimulus standpoint.
Yep. Yeah. So anyway, this 6.2% would be even higher if they had the same 2.9% inflation rate that we had, because it would push it up by a percent. It's just it's a flop. You add a percent of inflation, you take a percent off your real expenditures, and vice versa.
Yes.
Anyway, so backing this up though, remember they said here, look, this got me. Residential fixed investment actually added quite a bit to the overall pop. Residential fixed investment. So I'm sitting here, I'm like, Paul, but wait a minute. I've read the other reports, and maybe the other reports are wrong, but I keep up with all this data, and I remember this. So this comes from the Census Department. They said, well, okay, permits from September 23 to September 22 down 7.2%. How do you spend more on housing if you have 7.2% less permits? Well, that's permits. That's permits. Maybe we're completing them more.
Right.
Using housing units completed, September 23 to 22. 4.8% decline year over year. That's weird.
That is weird.
How are we spending more on residential fixed investment when we're not starting them and we're not finishing them? I
That's
don't get it.
Question. And I don't see the home building stocks responding to that, in any way whatsoever, that data. So I don't see it in price action either.
Yeah. So
I see them
this whole
declining
thing,
to the downside, not up.
This whole thing, right? So the consumer spending, I think, has not been appropriately adjusted for inflation.
No.
I didn't dig into private inventory investment. I do believe state, local, and federal government spending is out of control. That's holding up the whole thing. If they just didn't deficit spend at, what's the federal government deficit spending at right now? 6.5%, maybe 7% of GDP. Well, if it wasn't doing that, GDP would be back. It would be in deep recession. So
that's right.
And this residential fixed investment, this is junk as well. So the whole thing's just junk, as far as I can tell. But yet people have to make decisions and trade off of it. But I do feel sorry for anybody. You can't make decisions off of this. Politicians can feel better, but I can't imagine a single corporate officer sitting down and going, "This looks good, Paul. Let's hire people and increase our inventory levels."
Yeah.
Look, the economy's doing great.
Based off of this government data. Now, I can say the only number in there that I can say that I've seen a little bit as far as the data comes out, inventories were drawn down as companies were a little bit more cautious, trying to absorb those inflationary pressures last year. And they're having to replenish those a little bit, but not enough to dramatically turn things around. So, and Chris, this takes me back to the point where when it's so obvious that you can't trust the data that's coming out of the government, that there's twists and, to an extent, I can't say there's outright lies, but if you're lying at all, I consider that an outright lie. If you're using statistics to change the numbers, you are lying. So we talked several times in the past about how interest rates have risen so dramatically. Even though the Fed is quoting that they're going to pause for a period of time, it looks like the market's saying no more. Well, here's a question I would ask you. At what rate would you feel comfortable buying a 10-year government treasury right now?
10 years. So this means that if I have to hold to maturity, it's going to be the year 2033.
Yes.
Personally, I'm a little bearish on what happens because we know that by 2033, Social Security's bankrupt, totally out of its trust fund. We know that the US government has a structural deficit shortfall of at least $2 trillion a year for that entire 10-year period, unless they change spending laws.
Right.
So probably around 12%.
Okay. It's interesting because that was the number I had in my mind as well. But we're seeing the 20-year, since we talked last week, is up to 5.27% right now. So that's, we've seen a little bit of a backing off of the 10-year, but the 20-year is continuing to increase. Normally, if you can get paid inflation plus 3%, it makes sense to tie your money up for a 10 or a 20-year period of time. There is no way that I would do that right now. And especially with this level of fiscal spending, 12% can compensate you. But does that number still make you a little nervous?
A little bit.
Especially with this fiscal spending and the Fed's ability to, what if they reverse? What if they were to lower rates right now again? What if they were to reinstitute quantitative easing? I saw some news feeds this morning that there's some people that are getting pressed enough where they're like, hey, the Fed needs to come back with QE again. I mean, that would absolutely destroy house prices. I think the number right now is, to buy the average home in the US, you've got to have 114,000 in income. What's it going to take? 180 and 200 if they don't stay the course and pull this asset price inflation out of the market, which means, like Jeremy Grantham said, the final stages of the super bubble.
And by that, the way I hear that, I've been tracking this bubble for a long time. This bubble goes back decades.
Yes.
Right? And it's a bubble of complacency because the Fed's always going to bail us out. It's a bubble of magnificent proportions that saw stocks and bonds both hitting all-time highs at the same time, right? So a lot of people's like, oh, they printed all that money, it didn't lead to inflation. Like, that's because you're tracking milk and cars. No, inflation's a monetary phenomenon. Inflation happens where the money goes. So the Fed printed, they didn't put it in milk, in cars. They gave it to Wall Street. Well, what's Wall Street going to do with it? They buy Gulfstream 650s, fine gems, nice art, trophy properties, stocks, and bonds. All of those went up extraordinarily during that period of time when they were printing all that money. So I submit we did have inflation. Lots of it.
We did. It was in the asset prices more so than the cost of living. But now it's coming into that cost of living, and especially with the risk of the dollar's status on the global reserve stage. Yes, it's a safe haven interim period. Yes, that milkshake theory, and I cannot think of his name right now that put that out, Santiago Capital, was right. You're going to see the dollar rise initially, but we may be in a period of time where you got, who was it? I think it was Lennon, not necessarily a fan, but he made a very wise statement. There are decades where weeks happen, and there are weeks where decades happen. So I think that's correct. I may have butchered that a little bit, but I think we're in a period of time where things can change so dramatically and quickly that unless you're prepared, unless you have a strategy in place, unless you have considered ahead of time the decisions that you need to make when certain thresholds are crossed, it's going to be too late to do anything about it. And
I totally agree. Got to have a plan and a buy list. And a buy list. I get asked this question a lot. And again, just for educational purposes, not investment advice, but I've got dry powder. I'm just sitting on it. I'm waiting. I think there are better prices out there because I don't think the Fed has the political cover it needs, given how bad inflation is, because TikTok and Twitter is full of all these 20-something kids just crying, literally, about how they just can't get ahead. I think it would be very difficult for them politically here to cut and start QE again, but they want to. We all know they want to, right?
Oh, they want to.
I think they need a barn burner asset crash to step in and have that agency. They need people crying on TikTok and Twitter saying, please make this go up again, right?
Yeah, they do. They really do.
They don't have that.
If they want to do what's right for our future generations, then you're going to let you're going to stay here until housing prices come down 30 or 40, 50%. What that's going to do, and I'm not saying that's going to happen, I'm saying that's what should happen. That's going to drive the institutions out of the residential housing market, which is going to get back to the point where the average individual is competing against the average individual to purchase a house, not BlackRock coming in and buying up the whole community and taking everything off of the market, BlackRock or Blackstone. So, I do believe that this is a period of time. We have been cautious on the market. We have, I think back in July, we're sitting on about 65% treasury bills. And yeah, I have issues with treasury bills from a long-term standpoint, but if you're short-term in nature, technically that's the safest asset that you can own in the interim period, and it gives you dry powder. You have your precious metals, not a recommendation, just discussion for educational purposes. You have your precious metals from a long-term standpoint. That's like your fire insurance on your home. You have that there in case a catastrophic event happens, and then you operate a plan. You have to consider worst case scenario on any individual asset that's out there, because if you are in a position when this super bubble bursts, you're not going to be able to pick the bottom more than likely, but you don't have to if prices were to drop, let's say 40% or 50%, which is what the market would have to drop just to get back to historical normal valuations. Maybe it goes down
one of those big periods, right?
That's right.
It's like the pendulum doth swing, right? And so there's a time where it becomes all about paper. People get all fascinated with paper, speculation and paper, and it's stocks and which bonds and all that stuff. And then right now, the hated side of that pendulum swing over here is commodities, right? You've seen the chart which shows the ratio of commodity prices to paper, right? Which is like, say, equities or something, right? People get all fascinated with these and they hate these, and then the pendulum swings back and people get all fascinated with these and hate these. And but this is a generational moment of hatred for all things commodity related right now. It's really strong. And it'll swing back. It always does, right? And I'll know, Paul, people like, well, would you ever sell your gold? I'm like, yeah, when I go to a party and everybody's telling me about gold and not, Nvidia shares. Right? There'll be a moment.
Bingo. When they're like, will you please sell me some of your gold? I can't get any right now, and I'll swap my Nvidia shares for it if you'd be glad to take it. I'd be interested in swapping gold for Nvidia, assuming that their fundamentals are still relatively decent. But you're correct. Most people chase the returns of what everybody's talking about on TikTok or at the local party or get together. They're not buying what they need to buy because it takes patience, and that patience is what pays big dividends from a long-term standpoint. So you're right. You're right.
So this is important because people get very confused because the marketing is so good, but they think of the Federal Reserve as an extension of the federal government. It's they're of and by and for the people, and Jay Powell will stand up there, as did Greenspan and Yellen and Bernanke and et cetera, and they'll say, "Oh, we have two mandates. We have dual mandate, full employment, price stability," as if those were the things they actually cared about. Let's cut to the chase. That's all BS. They don't care about that stuff. You know what the Federal Reserve cares about? It has a product called the Federal Reserve Note that it manufactures out of thin air that commands extraordinary power. It will defend the dollar if necessary and burn everything else down. Careers, political careers, dynasties. Like it's like that's all it has. The dollar. It's like that's the only thing. It doesn't have another product. It's all it's got. And by the way, it's a fictitious product. So, they're going to want to keep that, I think.
I think they are too. Why would they want to give up that power? Why? I mean, just think about how many people are scrambling to get as close to the money printer as possible, as close to those individuals, and the power that gives them, and the desire that everybody generates to have a relationship with them. That's something that feeds our human nature, our weakness, and our emotions. They're not going to give that up easily. There's no way. I agree. Yeah. Very good statement. I haven't thought about it like that until you made that statement, but I believe that's a wise and true statement, Chris.
Well, thanks. And here's, I was going somewhere with it too, which is that I think we have a central bank that is now facing that choice and is going to have to deal with it first. So let's turn back now real quick to my old buddies, the Japanese. Because let's go. Yeah. All right. Yeah. Hey, everybody really needs to know about this. So it probably means nothing to somebody who doesn't track it, but the Japanese yen, now you need 150 of them to buy a single US dollar. And so that ratio of 150, Paul, they've been fighting not going through that level for months now. I mean,
Yes.
really fighting. And it's important for people to understand that Japan is a value add nation. They import all the raw materials practically and all of their energy practically.
Mm-hmm.
And they fashion that into higher value add products, right? Cars, semiconductors, do a great job. The issue is that the yen falls and goes from 100 to the dollar to 120 to 130, 40, 50. That's inflation. They're importing inflation now. There's no way to avoid that, right?
Correct.
So big deal. They have to fight that, but the Japanese central bank, and I have nothing but contempt for them, like I do a lot of central bankers, and contempt is not too strong a word. They've been just trying to they wanted to control both the price and the quantity of money. They were doing it called yield curve control, where they were just going to control the cost of money, right? Which is
Yes.
fundamentally, yeah. But they also didn't want their yen to get out of control. So they wanted both the price, which is the interest rate, and the quantity. They wanted both of those fixed. Like, you can't do that. So they
No.
did it. And it built up a lot of pressure. And now this pressure's popping. Right. So a
And
little context.
yes.
So this is, I don't know what's with this flat line, but when the yen starts showing up as a dollar pair back here in the early 70s, you can see it was about 300 and came down and comes down and comes down. So this is the 150 mark right here, which it's now popped back over. And so I think you can see that there's nothing but air up here. I mean, the next stop would be 175-ish. And then the
Mm-hmm.
next stop would be 225-ish, give or take.
Mm-hmm.
Right? So it's nothing but big fat round numbers up here. So that's the price that's what their money is worth. And then the price of it, they were really serious. They were going to keep their 10-year bond below 0.5%. And they did all the way up until August. And then it's getting away from them pretty profoundly here.
Very quickly.
So I know it
And
doesn't look like a lot, but that's a big amount actually to go from here to here on percentage terms.
that's a substantial amount. That's actually a 76% increase from 0.5 to 0.885.
Wow.
To
That
put
that
that,
has big impacts. But even with that, if you said, well, I'm going to get compensated for 0.88% over 10 years,
yeah.
but I'm going to be compensated in a currency that's going to be shedding maybe whole percentages per month in
Yes.
value, it just doesn't work out. So that's the huge tension. Like, who's going to be buying all the bonds? Well, that's the Bank of Japan. When they buy it, what do? Well, they have to print money out of thin air. Wait a minute, you're creating more money. Now the price of your money's fallen.
That's right.
Well, so that's what they're stuck in this rock and a hard place. But I think the reason I want to intro it the way I did, push comes to shove, the Bank of Japan really only has one product, and that's the yen.
Yes.
All the rest is things they're trying to do to satisfy various market participants and political careers. But at the end of the day, cornered, they'll defend the yen if they have to.
Absolutely. If they can, they will. And think about the decades of this yen carry trade, the substantial amounts of money that are in that carry trade, and when that unwinds, it's impossible. I'm sure there's somebody can figure it out, but it's impossible to fully consider the ripple effects and just how much damage that's going to do across the markets globally, and especially in the U.S.
Well, if there's no bulkheads in the ship, right?
That's right.
Then what happens? So when you really get in trouble is a nation state. So everybody has open capital borders, and that's why we see all the charts trading identical. So when you do get in trouble though, and you're like, oh no, gosh, our yen is under assault. What do we do? Really, there's not much you can do. You can either close the border, which means that's impossible. But if you did try and do that, boy, you trap a lot of people, panic ensues, billions and billions of dollars that suddenly don't want to be locked in that system, chaotically try to get out. So really, imposing capital controls is probably like the most nuclear of options, right? That's the big red button, like, uh-oh. Otherwise, you have to do what everybody else does, which is you have to raise interest rates enough to attract attention that people would come and want your currency again, because it's attractive. I like your bond. I'm going to have to buy it. I guess I'll have to buy some yen to buy your bond, right? So I don't know what interest rate Japan would have to raise up to, but they would have to become at least globally competitive.
Yes.
Which would be like, at least, and I would submit more when your currency's under assault, you have to go further. So 8%, 9%. Well, the Japanese government, the last thing I saw said that if their interest cost that they have to pay rises to 2%, they have to spend 100% of all their tax receipts just on interest costs.
Goodness.
They can't even afford 2% as a nation. That was last time I read about it. It's probably lower than that now, all things considered. So that's what they're really facing here. So the Bank of Japan is like, do I defend the currency, or if interest rates rise, because that's how I defend it, but if those rise far enough, my whole government goes into one of those meltdown things.
Yes.
Where it's borrowing to satisfy the cost of borrowing, which leads to more borrowing, which raises the cost of borrowing. It's that thing.
Which is a currency collapse event.
Yep. So that's my dark horse. I wouldn't even call it a black swan, because that's totally unexpected. This is kind of a dirty white swan.
You're right.
Slightly gray.
You can see the color changing before your eyes, right? Yes. Yep. You know it's coming.
So, well, but again, and it didn't have to be this way, because if the Central Bank of Japan, and I'm not to pick on them entirely, because all the central banks in the West did the same dumb stuff.
Yes.
But if they had just not gotten in the business of saying, we have to try and control all these things, and we're simply the lender of last resort, and let the market do what it needs to do from time to time, which is burn some companies down who made dumb decisions, to let that creative destruction of Schumpeter sweep across, not allow enough tinder to build up in the system that you are facing a systemic lights out event, if it does catch on fire. Right. But they didn't. They just kept intervening. And I'm sure it all made sense, and careers were built. But here we are. And this is, I think, where, decades are about to happen in weeks.
Decades are about to happen. And, and that's why it's so important to be careful, cautious right now. Have some exposure to certain categories. I will say our tools, from a relative strength perspective, commodities have moved into kind of the number one target. Now, we're not going heavily into them right now, because if we do get that flush, the market's been anticipating this year-end rally. I mean, at this point, it seems like the media is going year-end rally, year-end rally, year-end rally. And yes, we're at the point from a technical perspective where that can happen. Everybody's running this image around of the 1999 analog, and there's a lot of money managers out there that are thinking, hey, this is going to save my year, right? Because you basically have the S&P 7 this year. You've got 7 stocks that account for the majority of the market returns. The other 493 are basically zero for the year. So and we've started to see, just in the past couple of days, good news come out of their earnings, but Google cratered, Meta started to crater. So if those generals start to collapse, this can get out of control really quickly. And if you start to see some loss of the yen continues to have this ascent, these issues that are taking place, it could get out of control in a hurry. And if you haven't made the decision ahead of time that I'm going to choose to be patient, yes, I might leave a little bit of money on the table, but that's okay, because we've got a lot of popping and creaking around the edges. You may not be in a position to take advantage of the opportunities that are going to be out there. And again, I've shared with you my concern. We're going to have this 50, 40, 50, 60% decline. And then what are they going to do? Okay. Then what are they going to do? Are they going to let that happen? And it's going to be 15, 20 years before the markets get back to even? That's not outside the realm of possibility. Or are they going to go, what worked in the past? Oh, we printed all this money. Look what we did during COVID. And we were able to turn things around, and then all of a sudden they slam rates to zero and print. And then that's the straw that breaks the currency back. and all fiat currencies start coming apart, and we're awash with this ridiculous hyperinflation where there's few places to hide. But there are great places for the investor that's been in a position to take advantage of it. You know, international countries that are commodity based, those indexes, commodities in general, gold, silver specifically. I can't make the recommendation on cryptos, but they're showing some signs of strength here recently in the short run. But if you're adaptive and you're open-minded and willing to follow a strategy, something that can help you choose the right path when you come to these Ys in the road, you're going to be successful. You're going to be okay. You're going to be better than the average person. We're all going to be miserable if we have hyperinflation, but those who prepare are going to be better off. They're not going to lose as much ground as what the average person is.
It's very well said. And for those listening, if you're just seeing this out in the wild and you haven't been to Peak Prosperity, you might want to come by, because this Paul's touching on some important framing, as I call it, that's really important. And this the framing is this. So from 1918 to 1923, you had the German Weimar hyperinflation, right? Everybody's seen the pictures of people with wheelbarrows feeding bricks of currency into furnaces because that's the best use for them. And when you read sort of retail level books, like I go to Amazon and want to read about it, they're like, oh, this was a great wealth destruction that happened. Look at how many people lost their savings and they lost homes. They just present it like it's this mysterious thing, like a meteor came and smashed everybody's wealth and it just went away, right? Yeah. And it's actually the wrong framing. What happened was nothing happened to the wealth in the country, right? There were just as many. Real wealth comes from the buildings, the farms, the factories, the roads, the bridges. Nothing changed. That was all still there before and after. But who owned it? Now that did change. So it was not a wealth destruction, it was a wealth transfer. And I understand why the keepers of the system want to pretend like it's, so sorry for your loss, care to play again? When in fact, for people who are paying attention, you understand that there's ways in which you can keep your powder dry, be smart, be nimble, so that as that wealth transfer is unfolding, you are on the right side of the line. And I wish everybody could be on the right side of that line, but history says a lot of people won't pay attention. They won't care. They won't allow themselves to think that way. But there are people who can see it that way. So that's what I want to have people understand: is inflation is not some random act of the mysterious universe. It's a policy, and the policy benefits some and it punishes most everybody else. And once you understand that, you have a chance of tipping the odds in your favor.
Correct. Well said, Chris. Well said. And that's what you do such a phenomenal job of educating people, opening their eyes, helping them to understand what's really going on, and then helping them to see that there are ways that you can deal with this. You're going to have to roll up your sleeves. You're going to have to get courageous. You're going to have to work with people that care about each other, community, and this country. And those are the individuals that you're doing a good job educating, so that they can receive some of that wealth transfer. So it puts them in a position to where hopefully they can help lead some of the policy decisions locally, specifically on a state level, and ideally on a national level on the other side of this. Agreed.
So for everybody listening, I'm Chris Martinson of Peak Prosperity. This is Paul Kiker of Kiker Wealth Management. If you want to have a free consultation with Paul, no obligation, and I'm sure you do, you can get a hold of him through our website, which is at peakfinancialinvesting.com. Very easy form to fill out, and an email gets kicked out to Paul's team. They will get in touch with you. It's a very easy process, and based on the feedback I'm getting, a very enjoyable process.
Thank you, Chris. We've enjoyed meeting everybody. Most importantly, helping people understand how to plan and deal with what could be potentially around the corner.
Well, fantastic. Good service there. So thanks much. Hey, have a great weekend. We'll see you next week, I hope. And hopefully a whole decade hasn't passed by that time.
I hope not. Thank you, Chris, for what you do.
All right. Likewise. See you next time, Paul.